When analyzing stocks, people unfortunately have a bias towards looking at the latest results for a company. Sometimes this is appropriate, but many times this is the wrong approach. In cyclical businesses, you need to normalize earnings in order to correctly get the intrinsic value of a company. So I want to review an example, and Applied Materials is, I think, a good example to look at. And the reason why is Applied Materials is a company that has a very highly cyclical business. What does this company do? The name is very vague, Applied Materials, but if you're familiar with the chip business, you'll know that AMAT, which is the symbol for the stock, is the leading manufacturer of semiconductor capital equipment. So larger companies that manufacture chips, semiconductors that is, like Intel or AMD, they will go to Applied Materials to buy the equipment to put into their fabrication plants. Applied Materials has 4 segments, but the largest is the Silicon Systems Group, and it accounts for somewhere around 2/3 of sales. And this is really the source of their business. So the other segments that they have are pretty closely related to the Silicon Systems Group. What do? Well, they manufacture equipment for use in the front end of the semiconductor fabrication process. And this equipment addresses most of the primary steps in chip fabrication. So when you think of Applied Materials, it is a company that is in the information technology or IT sector. Its industry is semiconductor, and its sub-industry is semiconductor equipment. Why am I choosing this company to investigate? The reason why is this sub-industry is particularly cyclical. And here's the explanation for that. Historically, this industry has followed a certain dynamic. And what's happened is when the economy is doing well and people are buying lots of semiconductors, semiconductor manufacturers tend to extrapolate sales growth. They get very optimistic about what's going on in the industry. The second piece of this is that when they get optimistic, they tend to overinvest in equipment. Because when you build a fabrication plant, you can't build a small plant. You have to invest huge quantities of money and build a very big plant to get the cost down, the cost per unit. So as an example, Intel built a fabrication plant in 2013 and spent about $5 billion for it. So the cost is actually going up over time. Literally, when they get optimistic and overinvest, we're talking about massive plants. When they realize that they've overinvested and that the demand for the semiconductors isn't going to meet their optimistic sales expectations, then there's a fall off in the business for these equipment manufacturers. And the fall off tends to be huge as they work through this capacity, this excess capacity in the industries. So let's imagine that you're an analyst trying to value the stock of Applied Materials. You look at this industry, understanding the historical industry dynamics, and realize this is a very cyclical business. Therefore, you don't want to just look at the most recently released earnings associated with the company, because you're not convinced that they're exactly at the normal or average part of the business cycle. You may be looking at earnings. The most recent ones can be at the high point, the peak, or they could be at the trough of the earnings cycle. So your goal as an analyst is to try and normalize these earnings. And there's several steps for doing that. And let me just talk broadly about that, and then we'll apply these steps to Applied Materials. The first goal that you have is to determine the best measure for normalizing earnings. There are 3 basic ways. You can take the average dollar earnings for the firm, and if firms have not grown or shrunk, if they haven't engaged in any acquisitions or divestitures or organically grown the business, you can just take the average dollar earnings for the firm over the business cycle. This is a very easy approach. The second approach could be taking the average ROI, return on investment or return on invested capital, or looking at the profit margin for the firm. This is best for companies that have changed in size or they've expanded their scope or shrunk their scope. The third approach is to look at the average sector return on invested capital or profit margin. And I'm going to show you a little later a spreadsheet that Aswath Damodaran has on his website, and he's got the breakdown by sector of the return on investment and the profit margin. So it's a really great resource to try and get these sector ROIs and profit margins. The bottom line, though, is what approach is going to best represent the average earnings going forward for the company, and choose one of these three approaches based on that. The second step is to identify a typical business cycle. Now, what I'm really referring to is the business cycle for the particular company. But you can think about this in a broader context. If you look at the entire U.S. economy, there have been about 11 business cycles between 1945 and 2009. The average trough to previous trough length has been about 70 months or between 5 and 6 years. And a good resource for this is the NBER website. So NBER actually will show you the business cycle expansions and contractions, and they do a really great job of giving you the average. You can look at the average from 1854, but most people focus on the post-World War II average. And you can see here that 69.5, depending on how you measure it, it could be 68.5 is a good approach to look at. The reason why I bring up the business cycles for the overall U.S. economy is that some people take an approach to normalizing earnings that just takes the last 5 years of earnings for a company, and they assume that that represents the entire business cycle. On average, that might be about true, because you can see that the trough to previous trough length is somewhere between 5 and 6 years in the post-World War II economic history of the U.S. So 5 years sort of fits that. I prefer a more detailed approach where you're actually looking at the company's performance to try and figure out the business cycle in the industry, because it may not match the overall U.S. business cycle. But in a pinch, maybe 5 years just works. The third step is to calculate the average over the business cycle. So you can figure out what the average dollar earnings or return on investment or profit margin or sector average is going to be, whichever approach you use. So let's take a look at applied materials. I've created a graph that shows you in blue the stock price of applied materials, and the rust-colored bars are return on equity. And the reason why I'm plotting return on equity is to try and figure out how that company is going to perform and try to identify the starting point and the ending point of the business cycle. I've put a rectangle on this particular chart because I feel like that this rectangle captures the entire business cycle for applied materials. On the left-hand side, you see that return on equity is near peak at about 22%. And on the right-hand side, you can see that return on equity also peaks about that time period. The peak of this business cycle starts about 2007 and includes 2008, 2009, 2010, as well as it stops at the end of about 2011. So that's 5 years. So this fits in with this idea of the typical U.S. business cycle being 5 years, and here we've identified a peak-to-peak cycle or period that includes the business cycle for applied materials. KLA-Tencor is a competitor of applied materials, and if you do the same chart for KLA-Tencor, you see about the same graph. So one way of confirming this is by looking at the sector average or one of the competitors, and that works in this particular case. Okay, so step one is to choose an approach. Because applied materials has changed in size, I recommend looking at the return on invested capital for this company. Step two is to identify the typical business cycle. We've got a period that represents that. And so step three now is to calculate the average over this business cycle. I want to mention several ways that you can measure return on invested capital. Damodaran presents a formula in his investment valuation textbook which represents the return on invested capital, ROIC, as the after-tax EBIT divided by the book value of debt plus the book value of equity minus cash. Another way of looking at it is on a pre-tax basis. Sometimes this is defined as EBIT divided by the book value of debt plus the book value of equity. Different analysts take different approaches as to what to do with cash. Some subtract it off to get to that invested capital. Some don't bother adjusting it for it because they assume that that cash is needed is a key part of the operation. How do you get the historical total capital of the firm? My suggestion is to use Capital IQ, and on the left-hand side of the screen you can see that they have the capital structure summary. After you click on that, you can see that they have the capital structure data that's provided here, and it's giving you the total debt as well as the total equity. You probably need to slide this bar over to get more information, and then you can click go to get the time period that you want. And after Capital IQ downloads this, you can click on this picture of Excel. The spreadsheet that Capital IQ will load for you looks like this, and you can see that we've got the total capital right here for the 5 years that we need. So we've got one piece of this return on invested capital puzzle. The next thing that we need is, of course, the EBIT. You can click on income statement on the left-hand side of the Capital IQ website, and it will download the income statements, of course, for you. What you're really looking for to get the EBIT is this operating income. So click on this Excel icon, and it's going to download these income statements for you. Then after it opens the Excel spreadsheet, you can just copy the operating income, which is going to represent your EBIT, and put it into the spreadsheet that contains the total capital. And now what you can do is calculate a pre-tax measure of return on invested capital by dividing the EBIT by this measure of the total capital. We can put it in percent and just copy this over, and of course get the average. And you can see that the average return on invested capital for Applied Materials over the industry business cycle is 18.5%. It obviously ranges from 30% sometimes to a negative number sometimes. But if this industry continues to be cyclical, on average you can expect that they are going to have this return on invested capital over the business cycle of 18.5%. So once you've figured out that Applied Materials is going to earn an average pre-tax return on invested capital over the business cycle of about 18.5%, you can then get the normalized operating profit for Applied Materials by multiplying that pre-tax return on invested capital times the current total capital for the firm. Again, this is an adjustment for the size because AMT just merged with a company in Tokyo, and their size is significantly changed. But as long as you're staying in the same industry and you reasonably expect that they can achieve the same return on their capital, the normalized operating profit for Applied Materials is going to be $1,743,000,000. This is a much better approach to valuing the company, to use this normalized operating profit for a very cyclical company as opposed to just looking at the most recent earnings for the company, which may be at the peak or the trough or an abnormal part of the business cycle. So let me show you one other useful tool for normalizing earnings. You can Google Aswat Damodaran and it will take you right to his NYU website. He's got spreadsheets listed on his website, and he has a great spreadsheet for normalizing earnings. And this normalizes the earnings of a troubled firm using historical or industry averages. This is what the spreadsheet looks like right here. And you want to read this explanation first. He's got some earnings normalizers and outputs, but this allows you to adjust for R&D. It allows you to convert operating leases. And one part that I really like is it's got industry averages over here. So you can see that on row 82, it's got the semiconductor capital equipment industry, and for the whole industry, they've got a pre-tax operating margin in column I of about 24%, which is not too far off from the 18.5% that we calculated for applied materials. So I'm not going to go into detail about this spreadsheet, but it's another great tool that you can use.